In today's video, we're going to discuss the increase to the capital gains tax inclusion rate, how it affects you if you own a cottage or a rental property personally, and how it affects you if you're an incorporated business owner or a real estate investor that owns your rental properties in corporations. Let's go.
All right, we're here in the third week of April. The federal government has just released their financial budget here, and there's been some changes, particularly as they relate to capital gains. Gautam, why don't you kind of give us some insights into that?
So the main changes are that they've increased the capital gains tax inclusion rate, and it's different from whether you own an investment personally or in a corporation. So personally, the first $250,000 of the gain is the same as it was before. 50% of the gain gets added to your personal income, and then for gains above $250,000, it's now at the 66% inclusion rate, which effectively becomes about a 33 to a 36% personal tax rate because half that gets added to personal income. Now, corporations, however, were hit harder on this rule change, where that 66% inclusion rate takes in effect right away. So even if you have a house dollar gain, 66% of that is taxed at the corporate level. And yeah, basically that affects real estate investors, business owners. And we can kind of go down the list for the different scenarios. So the first that I didn't even think about after watching like a little video clip this morning is that if you own a cottage, right, that's a second home. That is a capital, you pay capital gains tax on sale. So say, you owned a family cottage in the family for the last 30 years, and then finally you decide to sell it. You may have done really well, and now you're paying capital gains tax, and you may be above that 250,000 threshold. So there could be a fairly high increase to the tax you would have paid before. The one caveat to that is if you own the property with a spouse or other family members, that 250,000 is per person. So if there's two people, 500,000, 3, 750. So there is an impact. It's probably not a crazy impact.
So if I own like a rental property with my spouse, and it's went up $400,000, this doesn't really affect me.
No.
Okay.
So the 250,000 gain per person stays at the current rate. It's only the portion beyond that gets taxed to the higher rate.
Okay. So that's, again, so from a personal perspective, it's probably not affecting
It's
a whole lot of people.
That's fair. There's not a lot of situations where you're being affected unless you already have a lot of assets. And that was kind of the goal with this increase, which was to target people with a large net worth and a large number of assets.
Okay, so explain just a little bit further on that. If you own a large number, because if you're selling multiple of them in a year, the capital gain, is that part of it? Because there's a compound, or?
It is on a yearly basis. So if you have more that, so you sell two properties. One has a 250,000 gain, that's under the gold rate. The other, whatever the gain is, now that's at the new rate. Okay, that's the annual gain is over 250.
Okay, and is that do you know if it's calendar year or is it from when the sale?
Should be calendar year.
Okay.
It's because you do it on your personal tax file.
Yeah, makes sense. Makes sense. Okay, sorry. Just want to kind of clarify that because obviously I think not a lot of people, at least maybe some of our audience, like real estate investors and stuff like that, a lot of them are probably going to own it with multiple people, right? So even if you like say get a flip and you're going to make 250 grand, but you own it with partners, it's not really.
Now flips are business income,
right?
But yeah, say you own a rental, you held it for a year, sold it in a situation, right? So pretty much if you own properties personally, I wouldn't worry about it, especially if you own a few properties. You can time the sales where you do one in 1 year, one the next year. So you should be okay unless you have a huge gain. And at that point, you're going to pay a little bit more. The next situation is incorporated business owners. So like you and I, we have our professional corporation where we earn our income and then we try to pay ourselves less than what we make, and what's retained in the business we then hopefully invested to grow. That's our retirement fund to build a nest egg, or to get us through tough times, right? If the business isn't doing well a certain year, that allows us to weather those storms, right? For that situation, you do pay the higher tax rate on the gains of your retained earnings. So you still get the benefit relative to earning the income personally. So if you were someone who was, say, a highly paid professional, say you're a doctor, right? You make 300K. And if you earn that personally, you're paying personal income taxes probably around 100 grand of that is going to tax. If you earn that in the corporation, if you're in a situation where, say, you are able to live off of 100,000,
Yeah.
So that you pay the personal tax of 100,000, the rest can stay in the corporation as a retained earnings, and you only pay 12.2% tax. So there's a big benefit to retained earnings in a corporation versus earning it personally. All this does is that 200,000 is not going to grow as fast because you're going to get hit with higher capital gains tax along the way. Now, if you're a buy and hold investor, you buy something and you wait 30 years, it will affect you, but by delaying it as long as possible, you're probably in a better spot. If you're involved in more transactions where you're locked in a capital gain occasionally, that does affect you more. But again, it is all the gains. And now, we may have different opinions on this. I think there's a lot of opinions around. I personally think it's okay because we get the benefit upfront by being able to retain earnings at a low rate. We do pay a higher tax after. Now, the impact on the economy is another story, right? Because, what are your thoughts on that?
Yeah, I think it's kind of interesting as to how it relates to that. Particularly, I mean, again, I think it comes down to maybe more like overall business investment where people are maybe going to sometimes do that. Like, I think for the smaller individual everyday person, that's probably not affecting things that much from the overall economy standpoint, economic standpoint.
Yeah.
But if you're, let's say, doing very well and you have like a lot of business opportunities and that's maybe how you make the money, and you know that you're going to pay a higher tax rate in, say, maybe Canada for a business that you buy and sell, and the same business that you buy and sell in the US, you may start looking to invest other than place out of Canada, right? So
I think it becomes a con when someone weighs their pros and cons. I think personally at least, you should always make financial decisions that fit what you want personally in your life.
Okay.
And what, you already planned on doing that makes good investment sense, and then optimize the taxes afterwards. Right? So in that same shoes, if you had $1 billion to invest, you have a lot of options if you're, a sovereign wealth fund or something. So yes, that's a factor, but I would assume that their decision making also still looks at the opportunity versus just the taxes.
No, for sure. I think it comes down to when you say like the sovereign investment fund or a much higher net worth individual has that opportunity. They're looking, okay, well, I can get 10% return here. I can get a 10% return here.
Then
now that I'm the deciding factor.
And to that point, Canada isn't necessarily stellar on the world stage in terms of productivity. We're actually behind. So if we don't have a lot of innovation, new startups, new ideas that require capital, and if the person investing here is at a higher rate, that's like a double negative, right? So so anyways, that's for a corporate professional who's investing retained earnings. Now, where this gets really tough are, as we know, many real estate investors who have T4 income. So they're paid, highly paid, they're skilled.
So you're an engineer or something like that.
Exactly.
With a lot of those things.
Yeah. You make a good personal income. You still live frugally, you try to save your money, and then you invest that money into a rental property. And then your lawyer tells you, hey, you have, a lot of equity in your personal home. To be safe, you should incorporate that property so that if any liability comes from that rental, it stays in the assets of the corporation. It doesn't affect you personally.
Yeah.
That may be a prudent thing to do if you have like a personal home that has a lot of equity, personal assets.
We know several people who did that when they were investing.
We have a lot of people actually. So that person now is really hit because originally the tax code was built on this concept of tax integration. You are supposed to pay the same tax rates whether you own assets personally, own assets in a corporation. And they took a lot of care to design that so that it wouldn't influence the decision you made. So you could just make a decision based on liability. Hey, I want to protect my liability, and I can do that without necessarily paying extra tax. Moving forward, that
not changed.
Yeah, now you're paying for the protection of a corporation. And unfortunately, I know several people who paid land transfer tax to move their property into a corporation in order to get the liability protection. Now they've hit twice.
Right. Like
they paid to move it in.
You're like, I'm going to pay $8,000, but this is worth it so I can protect myself. Yeah. And now all of a sudden you're like, well, you're also going to pay a little bit mine was actually much more than that 8,000.
Okay. Before you go off and rush to sell the property, again, capital gains is on the gain when you sell.
Yes.
Okay, this truly was a long-term investment. Let's wait 10 or 20 years. I think these tax rates can change, but keep in mind, in the 90s, the inclusion rate was as high as 75%. Now, the tax rate was not that much more than what it is now. And we can show a chart of this on the screen.
Okay.
Because back then, the inclusion rate went up to 75%, right? But income tax rates were lower, right? I think some of the higher tax brackets that went into the 50% didn't exist back then.
Okay.
So the overall highest tax you could pay on capital gains was roughly the 39%.
Okay.
So right now, even with a 66% inclusion rate, the highest tax you can pay is 36%.
Okay.
So it's not that much lower than the highest. I will say my personal opinion is that governments rarely reduce revenues. So hope is if the government changes in the next year, there's a different policy around this, but I think other things are probably going to change before this gets removed.
Or I'm not going to be highest on the priority list.
Exactly. So yeah. I wouldn't necessarily count on this going back to the 50% inclusion rate. I think if they did want to be more sensible about it, I would keep that first 250,000 capital gain exception within the corporations, because that would really only benefit the professionals and the people who weren't the mega corporations.
Yeah.
Because you're a mega corporation, you're going to have tens of millions of capital gains as you sell a factory and you buy something else. To that, it doesn't do anything.
Yeah.
But for a small business owner or real estate investor,
you're more upper middle class type person.
Exactly.
Right? Where you're trying to, the uber wealthy, like you're making 7 figures, 8 figures annually, you're going to get taxed. And
well, I think a bigger part of this is that goes back to tax integration.
Right.
If that same 250,000 benefit is available personally at the corporation, then the tax system is back to where it started. Even though tax rates are higher, we're back in that system where things make sense.
They balance out.
Yeah, because you don't want to, anyways, I think that was a thought out system, and it would be prudent to just keep it working.
Keep the well thought out system. That makes sense.
Yeah, so again, real estate investors, if you're incorporated, you're hit the hardest.
Yeah.
Assuming you want to sell.
Yeah.
But everyone sells in some way, whether it's when you die and your estate sells it, or whether you're selling it now to pay off your house or to do other goals you may have, right? At some point, you will sell. And right now, if your property is by a corporation, you're paying a higher tax rate. So
yeah. Now so we've got your regular person owning a cottage, you've got people just selling regular investments, businesses selling regular investments. What other kind of areas or people or transactions is this going to pin together overall effect on? Earlier we mentioned the sales of businesses and different things like that.
That's right. Yeah. So this is the curious side effect of this, right? Where they focus on what's written down in terms of the rules without actually looking at what happens in reality. So most business sales, small business sales, happen through asset sales versus share sales. So say we have a little bakery.
Okay.
We have a corporation that owns the bakery.
Yeah.
And also revenues, everything goes through that bakery. But the bakery has equipment. It has a list of customers, maybe the contact details, the newsletter, all the assets of the business are owned by the corporation.
Right.
We're ready to sort of close up shop. We find the buyer and we decide, hey, we want to sell this business for 200,000, right? And the buyer's like, yeah, that's a fair price. It's making a good income. How do you want to structure the sale? So as the sellers, we want to sell the shares of the corporation because there's a tax benefit as a business owner to sell. I think it's once in your lifetime up to 800,000 or $1 million where you can sell it tax free.
Yeah.
And that was just increased in this new budget.
Okay, so that seems like it's a good idea.
It seems useful, except that not a lot of small business owners can take advantage of it, because on the flip side of that transaction, the buyer rarely wants to accept a share sale. They would much rather prefer an asset sale, because as a buyer, when you buy shares, you can't depreciate it. Versus when you buy assets, you get depreciated every year to reduce your taxable income. So it's a lot more advantageous for the buyer to do an assets purchase and then for the seller to do a share sale. So what typically ends up happening is that benefit of the share sale, the tax benefit, is either shared or almost given to the buyer. So
like let's say like I got my family bakery.
Yeah.
It's been, I'm 60, 70 years old. I built this up from when I was a kid. I started now I want to sell this off to you. Maybe like a bigger corporation or something is trying to, that often happens there, show pop gets kind of bought up. So I want to sell my thing to you. I'm like, hey, the value of it's 200,000.
Yeah.
And I'm like, hey, I want to do this in a share sale.
Yeah.
You're a big Mr. Corp guy. Like, hey, we're not going to do this in a share sale.
Yeah.
There's going to be, say, a $20,000 tax difference if we do this in.
Well, let's look at the example, right? So if it's a $200,000 sale,
Yeah.
and now the capital gains tax went from the 50% inclusion rate to the 66.
Yep.
So if the asset sale happens within the corporation, now the tax goes up by 33%. And if your cost basis was zero, so assuming it's been depreciated to zero because you just own all the assets forever, right? Then your tax went up by 33%. Now, practically what ends up happening is that if the buyer is smart, they're going to say, hey, it's a lot more advantageous to do a share sale now. So if I'm going to do it, I'm not going to offer you, 200,000. I can offer you 150. Mm-hmm. But if you do an asset sale, I'll give you 200. But to the seller, you're making less money regardless, right? Either you give it for less in a share sale, or you get more and then you pay capital gains tax. So it does affect practically, I think, all small business owners who are selling their businesses.
Right. Yeah, that's interesting how kind of, you're increasing the share sale, which is like, oh, that may actually kind of work better. But then when you get into the practical reality of it, like most sales don't happen.
Yep.
Right. And I think, you and I chatted a little earlier, like oftentimes in that kind of business to business sale, like it's generally more of a buyer's market than a seller's market. Right?
It's generally a buyer's market. Many of these sales happen where the seller will seller finance the sale. So they'll get 50% or something because, again, like share sales are tough. The buyer doesn't get the tax advantage. A bank doesn't like to lend on a share sale either. They will typically only lend on the assets of the business, right? And if you have like old equipment in a bakery, that's working fine, but it's old. There's not much value in that to get a loan against, right? So many times the seller has to say, hey, off my 200,000, pay me back my 100,000 over the next 5 years, give me a little bit of interest, but pay me back slowly and give me the other half upfront. So something like that.
Mm-hmm.
So yeah, it does affect business owners looking to retire by selling their business.
Yeah.
It affects business owners looking to retire by saving retained earnings, growing it, going to pay a higher capital gains tax. So I think overall this was pretty tough on business owners and especially tough on salaried but corporate real estate investors. So
yeah. Or even like salary somebody who owns a small business on the side that's a corporation or something like that, right? Like yeah, interesting. Very, very interesting.
Yeah, I think my one final thought with all of this is, I already see a lot of negative reactions from these. A lot of people.
I think you get the knee-jerk reaction, right?
Yes.
Anytime somebody comes and says they're taking money from your pocket, your initial reaction is it's not going to be great, right? But yeah, like, explain a little bit more as how you think this actually plays out, right?
Yeah, so I think this is a personal opinion. I am not as jaded about it, I will say. And it took a few days for me to think about it. Because initially I was like, why are they doing this?
Why are they killing
just one thing after another? They always seem to do something that, it is kind of division of classes, right? We're going to tax the rich, we're going to help the middle class, but the rich is not quite the rich because if you're middle class, you're almost rich now. And if you're
the eroding of the middle class is maybe not a topic for today, but something that's pretty well renowned and talked about pretty frequently, right? So,
but the one example that I go back to is I was watching a video of Warren and Charlie, Warren Buffett, Charlie Munger. They were talking about, is it a terrible idea to increase capital gains taxes? And what they explained was if you're a salaried person, you're paying 30% income tax. And say you were fortunate to buy Berkshire Hathaway shares in the 70s, and then you've done very well.
You do okay.
And then what you decide is you're going to sell a share a year to sort of fund your living expenses. It's never going to run out, right? Because you made a great investment decision. Is it fair that the person who's just peeling off a few shares to cover their living expenses pays a significantly less income tax because it's a capital gain versus income? Their opinion was, it probably did seem like a fair outcome in society. And there is something in society where if the majority of people feel like it's unfair, it does hurt some of the social fabric.
For sure.
Right? Because that class division, that feeling of animosity towards another class of people is probably not good in society. So again, I'm not a fan, but if you look at the overall budget, I think a big amount of the spending is around housing. Increasing housing. So if we theoretically think that the money that's being taxed is going towards housing, and if that housing spend actually results in new house creation, which it's questionable, but it is probably a good thing for society. So anyways, I'm not necessarily a fan of increased taxes in any way, but I feel the reaction of some people who say like, let's leave, well, let's go somewhere else. I lived in Sri Lanka. I grew up in Sri Lanka. They have some absurd tax situations, and the country is poor. And they have so many other problems. So I think it is important to just take a second to think, Canada is still an amazing place to live, and we may just have to pay a little bit more taxes to it. That is what it is.
Fair enough. Fair enough. Do you think it'll change much from the private real estate investment side because this is going on? Do you think it will deter a lot of people? Do you think there's going to be a reaction to that? Because obviously, that is the other kind of side of this, right? This disproportionately affects real estate investors who, as you and I know, a lot of real estate investors we work with have added to the rental housing supply by creating units and doing different ways like that. Do you think this detracts people from doing that?
Yeah, already we've seen when interest rates went up, private investors kind of took a step back for sure. Like cash flow, when I spent all this money renovating, right? So already that slowed down a lot. Now, there is a threshold where I was, messaging an investor just yesterday, and he was like, I think I'd rather just put my money in index funds, right? That you can own personally. There's no fear of that,
there's no liability.
Right?
No tenant suing you in an index fund. You're good to go.
Exactly. So now your real estate was supposed to be taxed less. And, if you're buying anything larger than like a duplex, maybe a fourplex, you're okay holding it personally, but you start looking at a multifamily building, rarely do you want to own it personally when you have that many tenants involved. So you're probably going to hurt how much money goes into some form of housing and creation of housing. But at the same time, they have given some tax benefits for the creation of housing. Like there's an increased sort of ability to depreciate a fully constructed, like if you build I think it was anything above 4 units.
Okay, so you might go build a $6 or something.
So you can depreciate, I believe, up to 10% of it the first year. So again, that's not a tax benefit. It's kind of like a deferral. So you get less taxes up front, and then you pay back when you sell. So, right. But to answer your question, I think it's the same as the decision for the institutional investor to decide Canada or not. It's a similar decision. I think if you think real estate is going to do well in the long term, you're going to invest in it even if you pay higher taxes. But if it was marginal, where the benefit was almost the same, that the hassle factor of real estate wasn't making up for the increased return. And now you're going to get taxed on it more. Maybe on the margin pushes more people over into sort of investments they can hold personally and not have to worry about corporations and all.
So interesting. It'll be interesting to see, I think, how this all plays out, particularly we're kind of at the end of a term, I guess, we're nearing it anyways. Maybe a year, whatever left. So I think it'll be interesting to see how it all plays out, particularly that's the next kind of election rolls around as well. Interesting. I think it's probably not as big of a deal as the particularly like the investment community, maybe let's say, like makes it of it. Like, you know, I'm sure your investment groups, I'm investment groups. This is like the only thing that's been talked about in those things for the last few days.
Yeah.
And I think the initial reaction is probably larger than maybe it needs to be. But that being said, it does still tell us a lot, I think, about the sentiment that's around. Yeah. Right. So
it's the last couple of years have been tough for investors anyway.
Yeah. So they just feel like they're being kicked on their down right now.
It just feels, especially when they are needed the most to create housing.
Yes.
It just feels probably not the right road. Right. People are hurt, right?
Yeah. Interesting. Awesome. Well, thanks for sharing those thoughts. I definitely learned a lot about the kind of capital gains and some other factors I didn't really think about, right? Like I think, you know, the business sale, even like cottages, there's a lot of different kind of factors that you initially may not think about. So very informative.
All right. Hope you enjoyed this video. And if you're interested in learning about whether it makes sense to lock in your variable rate mortgage into a fixed mortgage, definitely go to Ryan's YouTube channel and subscribe, because he's going to have videos shortly of us discussing exactly that topic. Until next time, all the best.
Thanks.